Today I'm going to show you why I made a move that traditional investors would call unnecessary, completely switching from QYLD UCITS to JEPQ UCITS ETF in a single transaction. A move that should increase my total returns while still give me those juicy monthly distributions. Look at these numbers from the US versions, which the UCITS ETFs replicate. QYLD gave a respectable 9.2 compound annual growth rate with dividend reinvested. Not bad, right? But JEPQ, an insane 13.63% compound annual growth rate. That's nearly 50% better performance while still getting those monthly checks. And even worse, look at what happens if you don't reinvest dividends. QYLD's price actually drops below your initial investment. This is a disaster for income investors. Are you ready to learn why I made this immediate switch and whether you should do the same with your European portfolio? Then stay tuned, because this is going to be one of the most valuable videos I've ever made for European investors like us. Welcome to Psycho Investor, where we don't just chase ordinary returns, we hunt down extreme yields and make them our own. I'm not here to tell you about safe 2% dividend stocks. I'm here to show you how to build an income-generating machine for European investors. And just for your information, my 6 figures income portfolio is generating me between 30 to 40K annually after tax. If you're new here, a quick reminder, if you don't like my Eastern European accent, just mute the video, turn on the subtitles and collect that valuable info. Today we are diving deep into a portfolio move that separates the real psycho investors from the gamblers. My immediate and complete transition from QYLD UCITS to JEPQ UCITS ETF. And I'm going to show you exactly why I did it with real numbers, real analysis, and a strategy you can implement yourself on European exchanges. So for those of you who've been following this channel, you know QYLD UCITS ETF has been one of my foundation positions. So why did I suddenly switch 100% of my position to JEPQ UCITS ETF? Let's dive in and find out. Let me first explain what we are talking about for those who might be new to this covered call ETFs, particularly the UCITS versions available to us in Europe. QYLD UCITS ETF, or the Global X Nasdaq 100 covered call UCITS ETF, has been available to European investors for some time now. It's simple. It holds the Nasdaq 100 stocks and sells covered calls against the entire index to generate income. This gives you exposure to tech giants like Apple, Microsoft, and Nvidia, while generating monthly income through option premiums. For years, it delivered exactly what it promised: 10 to 12% annual yield paid monthly. It was one of my foundation positions, making up around 20 to 25% of my portfolio. But then JEPQ UCITS entered the European scene, the JP Morgan Nasdaq Equity Premium Income UCITS ETF. It follows a similar strategy but with crucial differences. JEPQ UCITS combines equity-linked notes, ELNs, with a curated portfolio of Nasdaq stocks. It uses a more selective, active approach to covered call writing. It aims to maintain more upside potential while still generating income. So now, let's be completely transparent here. The UCITS version of these ETFs are relatively new in Europe, and they don't have extensive track records yet. But here's what's crucial. The US versions of these ETFs has been around longer and have established clear performance patterns. Look at this basket with dividend reinvestment. Starting with $10,000 in each, JEPQ grew to $14,521, while QYLD only reached $12,929. That's a compound annual growth of 13.63% for JEPQ versus just 9.2% for QYLD. And look at the best year performance: 36.27% for JEPQ versus 22.92% for QYLD. But it gets even more dramatic when we look at what happens without dividend reinvestment. This is absolutely shocking. Without reinvesting dividends, QYLD actually lost money, dropping to $9,000. That's a negative 3.4% compound annual growth. Meanwhile, JEPQ still grew to $10,438. This is critical information for retirees or anyone using these ETFs for income rather than reinvesting. I made my decisions to switch based primarily on this US data, with the understanding that the UCITS versions follow the same investment strategies and should deliver similar relative performance. The fundamental structural advantages that make JEPQ outperform in the US market are replicated in the UCITS versions. Now, let's get into the psycho level of analysis of exactly how these two ETFs differ and why it matters so much for your returns, even in the UCITS versions. First, let's talk strategy difference. The QYLD UCITS ETF uses a passive strategy. It blindly replicates the CBOE Nasdaq 100 buy right index, just like its US counterpart. It's selling at-the-money call options against entire portfolio, which gives you maximum income but severely caps your upside. JEPQ UCITS, on the other hand, uses an active management approach. The portfolio managers don't just blindly sell calls, they allocate up to 20% of assets to equity-linked notes, maintain a basket of carefully selected Nasdaq stocks focusing on lower volatility, and dynamically adjust their option strategy based on market conditions. This active approach is absolutely critical because it gives JEPQ flexibility that QYLD simply doesn't have. When tech markets went crazy with the AI boom, QYLD's rigged strategy capped its upside. But JEPQ's managers could adjust their positions, increasing exposure to Nvidia and Microsoft while using more tailored option contracts. Now let's look more closely at those backtest results. Notice the performance difference with dividend reinvestment. JEPQ delivered a compound annual growth of 13.63 versus QYLD 9.2. But here's what really caught my attention. The Sharpe ratio, which measures risk-adjusted returns, was 0.64 for JEPQ versus only 0.46 for QYLD. And the Sortino ratio was even more dramatic. 2.31 for JEPQ versus 1.15 for QYLD. But the backtest without dividend reinvestment is truly eye-opening. QYLD actually lost money with a negative 3.4 compound annual growth, while JEPQ still grew slightly. Look at the negative Sharpe ratio of 0.3% for QYLD. That means it's producing worse risk-adjusted returns than risk-free assets. It's absolutely unacceptable for a foundational position. What this clearly shows is that QYLD is entirely dependent on dividend reinvestment to produce any meaningful returns. The actual share price has been steadily eroding. For anyone taking distributions like retirees or those using for income, QYLD is actually destructive to capital over time. For anyone taking distributions like retirees or those using for income, QYLD is actually destructive to capital over time. Now, it's important to understand that while UCITS versions use swaps and derivatives to replicate these strategies, due to European regulations, the fundamental approach remains the same. The US version's data gives us a clear picture of how these strategies perform over time, and I'm confident that the UCITS versions will follow similar patterns. Another critical factor shown in the backtest is volatility. Look at the standard deviation numbers. Even though JEPQ delivered higher returns, it did so with comparable or even slightly higher volatility, 15.03 versus 11.94% with dividend reinvestment. But what's crucial is the downside protection. Look at the worst year comparison. JEPQ's worst year was minus 6.45% compared to QYLD's 7.02 -% with dividend reinvestment. Without reinvestment, JEPQ's worst year was minus 8.94 versus QYLD devastating 10.54. This means JEPQ is protecting capital better during drawdowns while still delivering superior performance during upswings. And speaking of efficiency, let's talk expenses. JEPQ UCITS charges 0.35% annually compared to QYLD UCITS at 0.45. That's a 22% reduction in fees, which means more money staying in your pocket over time. On a $100,000 investment, that's a saving of $220 per year. Not life-changing, but every bit counts when we are engineering an income machine. Before we move on to implementation, there is one more technical advantage I need to highlight: institutional confidence. JPQ has grown to 24 billion in assets under management in the US. That's double QYLD's 12 billion. While the UCITS versions are still growing their asset base, we are seeing similar increasing interest from European institutional investors. This strong institutional adoption in the US gives me confidence that UCITS versions is following a proven strategy with massive institutional validation. Now let's get to the part you've been waiting for. Exactly how we implemented this switch and how you can do the same. First, let's talk position sizing. As I've always said, position sizing is what separates psycho investors from gamblers. In my previous portfolio allocation, QYLD made up around 20 to 25% of my total portfolio, one of my foundation positions. When I made the switch to JPQ, I maintained a similar allocation, keeping it as a core foundational position. I just sold all my QYLD and moved my funds into JPQ. For those of you in Europe, pay close attention. JPQ is available to European investors through its UCITS version, which trades under ticker JPQ on the London Stock Exchange. Always use limit orders when entering positions to get better fills, especially with the slightly wider spreads on European exchanges. Now, when is the best time to enter JPQ UCITS ETF? Just like with our other strategies, market volatility can create excellent entry points. If the Nasdaq drops 3% or more in a day, that can create an attractive entry point as option premiums tend to be higher during volatile periods. Now let's dive deep into UCITS specific considerations because this is critical information for European investors. Both QYLD UCITS and JPQ UCITS are Irish domiciled funds, which gives them significant tax advantages. Ireland's tax treaties with many countries can reduce withholding taxes on dividends compared to US domiciled ETFs. This is especially important for income-focused investments. Let's talk about where you can buy these UCITS ETFs. Both trade on the London Stock Exchange, with JPQ UCITS having the ticker JPQ and QYLD UCITS trading under QYLD. They are also available on some European exchanges like Xetra and Borsa Italiana. The key advantage here is that you avoid the PFIC reporting requirements that come with holding US domiciled ETFs. In terms of liquidity, while UCITS versions have lower trading volumes than their US counterparts, I found that using limit orders close to the NAV net asset value usually returns in good fills. The spreads on JPQ UCITS have been tightening as more investors discover it, which is another positive sign. Another critical difference in the UCITS versions is the distribution schedule. While both pay monthly distributions, the exact payment dates can differ slightly from their US counterparts. Make sure to check the fund provider's website for the most up-to-date distribution calendar. One thing to note about UCITS versions is that they use swaps and other derivatives to replicate the strategies of their US counterparts due to European regulations. This synthetic replication doesn't change the fundamental value proposition, but it's something to be aware of from technical perspective. Let's make address one more common question I get. Why not to just buy QQQ or TQQQ instead of a covered call ETF? That's a fair question. If you want pure growth, those are better options. But remember, we are building an income-generating machine here. JPQ gives us that sweet spot of meaningful upside potential while still delivering those monthly distributions. In terms of monitoring your JPQ position, I recommend focusing on total return, price plus distributions versus the Nasdaq 100, distribution sustainability, which is payout ratio, and volatility during market drawdowns. JPQ should outperform QYLD in all three metrics over time. Now let's look ahead for what we can expect from JPQ in the coming years and why the strategy will continue to shine. First, let's consider where we are in the market cycle. With tech innovation accelerating through AI, quantum computing, and other breakthrough technologies, the Nasdaq 100 remains positioned for long-term growth. JPQ's more flexible approach allows it to capture more of this upside than QYLD's rigid strategy. Second, volatility is likely to remain elevated in the coming years as markets digest everything from geopolitical tensions to central bank policies. This creates an ideal environment for JPQ's active management approach. Higher volatility means higher option premiums, which translates to potentially higher yields. Third, the institutional adoption of JEPQ continues to grow. That's 24 billion assets under management isn't coming from retail investors like us. It's massive institutional money voting with their dollars. This continuing growth validates the strategy and improves the fund's operational efficiency. Looking at specific catalysts, JP Morgan's management team has demonstrated skill in navigating market turbulence. During the 2022 tech sell-off, they adjusted their option strategy to provide better downside protection. During the 2023-2024 AI boom, they positioned the fund to capture more upside. This adaptability is exactly what we want in a core portfolio position. The sustainability of JEPQ's distribution is also worth highlighting. Its lower payout ratio of 339% versus QYLD's 411% suggests its distribution is better covered by the income it generates. This means there's less risk of distribution cuts in the future. As the ETF continues to mature, we may even see innovation in its strategies that further enhance its risk-adjusted returns. Now let's be clear, JEPQ isn't without risks, and it's important we address them directly. First, while JEPQ offers more upside potential than QYLD, it will still underperform the Nasdaq 100 during strong bull markets. That's the trade-off for getting monthly income. If we get another 99-style tech bubble, QQQ or even TQQQ would outperform JEPQ significantly on a total return basis. Second, both QYLD and JEPQ can suffer in prolonged bear markets. If the Nasdaq 100 enters a multi-year downtrend, both ETFs will likely see price erosion. The income from options premiums helps cushion this decline, but it doesn't eliminate it. Third, there is manager risk with JEPQ that doesn't exist with QYLD. Since JEPQ uses active management, the skill of the portfolio managers directly impacts returns. If the current management team changes or their strategy falters, performance could suffer. So let's recap what we've learned today about these ETFs. The US version of JEPQ has shown substantially better total returns than US QYLD while still providing strong monthly income. The UCITS versions of these ETFs follow the same investment strategies and should deliver similar relative performance over time. JEPQ UCITS has a lower expense ratio, 0.35 versus 0.45, than QYLD UCITS. The active management approach of JEPQ, which has proven successful in the US, should translate to similar advantages in the UCITS version. I made my decisions to immediately switch from QYLD to JEPQ based on the compelling performance data from the US version. While the UCITS versions are newer with less historical data, I'm confident that the same structural advantages will apply over time. This is exactly the kind of strategic move that separates psycho investors from average investors. We look at the data, understand the mechanics, and make decisive moves when the evidence is clear, even if it means being early adopters of newer UCITS ETFs. When I saw how US versions compared, I didn't hesitate. I switched my entire position immediately. The evidence from the US market was simply too compelling to ignore or implement gradually. And I believe the same advantages will play out in the European versions. Now I want to hear from you. Have you made the switch from QYLD UCITS to JEPQ UCITS? Are you considering it after watching this video? Drop a comment below with your thoughts and questions. If you found this analysis valuable, especially as a European investor looking for optimized income strategies, smash that subscribe button and hit the notification bell. We're building the most insane, high-yield community for European investors on YouTube, and I want you to be part of it. Remember, they called us crazy for chasing these yields with European ETFs. Let's show them how crazy profitable our strategies can be. Stay psycho, stay profitable, and I'll see you in the next video.